$700,000 sounds like a lot of money. After all, it's the better part of $1 million. That's about how much money Champlain Towers South, a 136-unit, 40-year-old, 12-story high-rise, had in its reserve account prior to its collapse. You can do a lot with $700,000, but the important question is, was it enough? Champlain Towers South had extensive deferred maintenance. The reserve needs, measured in 2020, were in the range of $10 million. Compared to that, $700,000 starts to look pretty small. And that's the key. What are you focusing on at your association? The size of your reserve balance? The size of your monthly assessments? Let me point you towards a more important number to follow, your percent funded. That's the comparison of your association's reserve cash to the association's reserve needs. With a single number, percent funded reveals the combined physical and financial health of your building. In the case of Champlain Towers South, they had $700,000 in reserves, but the reserve needs were $10 million. That means they were only 7% funded. That's a long ways away from reserve fund strength, which begins at 70%. So how do you get the homeowners to buy into a plan to build a strong reserve fund? Listen in as I share best practices to effectively communicate the topic of reserve contributions to homeowners. Julie, I want to follow up on something you said about short-sightedness and knowing what they're trying to accomplish, and the whole courage question. When the board is, the only number they have to look at is the monthly assessment rate, there's a tendency to want to keep that low. Yep. And we call that pursuing the fool's gold of low monthly assessments, because that gets you nowhere. The building has needs. And as much as we can, we try to encourage boards to look at a true number. You talked about their role to protect, maintain, enhance the assets of the corporation. You can look at that combined relationship between the property's physical and financial condition in the percent funded that's reported in the reserve study. That's the big number. And it's that number that will sway the association. So you have enough money to do things in a timely manner, or you don't have enough money. When your percent funded is in the 0 to 30% range, that's where special assessments and deferred maintenance are common. In the 30 to 70% middle range, special assessments are infrequent. They happen, but they're somewhat rare. When your percent funded is above 70%, special assessments are indeed rare. Those are the associations that, when they get things done in a timely manner. When the roof fails and it's $250,000, the board says, "Oh no," and they all fall off the chairs. But then they look at their reserve study and they say, "Oh, we've got that. We have it." Yeah. And they write the check and they make it happen. They don't have water leaks in the top floor. Things work so much better when you have the cash. And that gives the board a better, more effective target to be looking at. And
it gives the board tremendous credibility in the eyes of the owners too, because they know what they're doing, they manage it well, and when things need to be fixed, it gets fixed. It doesn't wait for, we'll try and eke it out next year while things starting to look in disrepair, which nobody likes. People may think they don't want to pay, but they for sure like coming into entry gates that work and are painted.
Yep, and elevators that. Yeah. All 4 elevators work reliably.
Oh, at once? Yeah.
How about
exactly.
that? Yeah. Oh, no. And I want to do a little more linkage to the courage. Sure. There will be some in the chat or the Q&A that ask about how do you go about making the case for raising reserve contributions or making reserve contributions. And again, that's the communication. How are you going to engage the homeowners to support it in areas or at associations where the homeowners have a vote in the say? They have perhaps line item veto, or they get to approve the budget. Well, the key is with reserves, make sure you are explaining reserves as the cost of ongoing deterioration. The roof deteriorates a little bit each month. And just because the roof doesn't send a bill, that doesn't mean it's a bill that you can avoid. The roof deterioration bill is real. It's as real as the electric bill, the management bill, or any other bill at the association. So characterize reserve contributions as offsetting ongoing deterioration. Don't talk about it for the future, for a rainy day, for the next roof, because then it starts to seem like it's someone else's problem. So
or for the next board, or 10 years down, I'll move out by then.
There you go. Not my problem. Say, right. Hey, we're not talking about the next roof. All we're doing is the small cost of offsetting ongoing deterioration. Mm-hmm. We're paying that bill of the roof bill, the asphalt bill, a little bit each month. And when you take care of the present, the future takes care of itself.
Absolutely correct. Absolutely correct.
At Association Reserves, we make the present less stressful and the future more secure. If you want to join us in this mission, please like this video and subscribe to our channel. Leave a comment down below on what you would like to see us address in a future video. Let's plan for your best future.